Nomura just placed a $29 price target on this stock, and that's 388% above today's closing price. Is it time to go all in on this overlooked biotech stock? Now, before we get into today's stock, I want to be clear. You are viewing a channel like this because you want to be a successful investor. Successful investors don't just take a hot tip they hear about a stock on YouTube or on TV or anywhere and just go run out and buy shares. A real investor will take that research, take that tip, and go do some research before buying the stock. Luckily for you, I'm going to walk you through today a little bit of due diligence. So sit back and relax. Here we go. So Nomura is a Japanese financial holding company, essentially kind of like an investment bank. It provides all kinds of investment related services, including providing stock tips and picks. Last week, Nomura made a call calling for a 388% upside in a little known biotech stock called Protagonist Therapeutics. The stock is currently trading at about $6.60 per share, and Nomura thinks it can soar to $29 based on its PTG 300 injectable peptide. When the company last reported clinical results on PTG 300 back in December, the stock crashed from $8 per share down to about $4 per share all in one day, only to bounce back all the way up to about $8 per share the following day. Now, after looking at the stock chart and the recent news for the company, what I like to do is pull up the company's latest quarterly filings, or in this case, it's actually the annual report for the company. You usually find the company's website, and it's pretty easy to find these. Here's Form 10-K. Now, since this is a company I know nothing about, what I like to do is come to item 1 in these 10Ks, and it has an overview of the business here. And we can see here, this is a clinical stage biopharmaceutical company, which basically means it is doing lots of tests and trials, and they're all in different phases as well. And they give you an idea here on the product pipeline. It looks like they have these blood disorder ones, and then they have these pills or these things that you take orally here. And as we can see, they're really only on phase 2. It appears on this drug here, and they have all these other ones. They're telling you when they're going to start. Now, these timelines aren't firm. This is obviously what the company would like to do, but if you're a doctor, if you have a background in science, all this stuff might make more sense. Personally, I'm not going to pretend that I know a lot about this, so that's going to lump this company into a very, very speculative investment for me, and so I'm going to size that to my risk tolerance and the portfolio size that I'm dealing with. So given that I'm not a doctor and I don't have a science background, the next step for me to do is actually dip into the company's financial data. And we're looking again at the annual report here. And what I like here is it gives me, essentially like a 5-year view here of what the company has accomplished. Now we notice here when it first kind of started, they didn't have any revenue here. This is revenue right here. Boy, they didn't have any revenue, and it started to pick up, but notice it really dipped very quickly here. These numbers are in thousands, so this is very, very little revenue here, and this is a lot of revenue. So it's kind of lumpy, which it tends to be with these early stage kind of medicine companies. So again, that's another reason why this would be a very speculative investment, not a cornerstone of your portfolio or anything like that. Now we notice that these research and development fees here, or these costs, are going up and up every year, even when revenue dips. So that's something you want to keep in mind. It probably will have a big impact on the share price as well. These general and administrative costs are also steadily ticking up as well. And then here we have our total operating expenses. This is money going out the door to help operate the business. It is going up and up every year, even when you have rapid decline in revenue. That is worrisome, but also not too uncommon for these early stage companies. Now we have loss from operations. Again, this is going to go up even as this revenue is declining, and especially when it does. Notice that the loss from operation nearly doubled in the last year or so. Now, moving through this a little bit, the other big thing you want to keep in mind on this is an early stage company. Take a look. They had 251,000 shares back in 2015. Notice that this figures are except for share data. So this share data is as written. Now look how many shares they have. 25, nearly 26 million shares. Guys, that is dilution at its finest. I will put a link in the description below and up above on my video about share dilution. Look at this, guys. Look how diluted you are getting a shareholder. That's why it's not always great to be an early investor to these very early stage companies, because you were one of 250,000 back in 2015. Now your one share is one of 25, nearly 26 million shares. That would be worrisome to me as an investor. Now, we saw that the company lost over $80 million last year, and that's basically with no revenue coming in. And so if you want to project like the worst case scenario is that 2020 will be the same. Now, you can dig into these financials and dig into information and press releases about the company to see if that's true or not. That's part of the process of doing your due diligence on these new stocks. Now, what you might want to also look at is say, hey, what's the cash balance? What kind of money does this company have on hand just in case they have another rough year where they don't have a lot of revenue, just like last year, and they have to burn through a bunch of cash just to stay alive? Well, notice here that we have cash and cash equivalents. This is very readily ticked up. Well, again, like the stock, the number of shares outstanding is ticked up. So the company has this $133 million of cash and marketable securities on the balance sheet. So they could survive technically another really bad year and still have a little bit of cash left over as long as it didn't tick up that much. Now, they do have some long-term debt. Notice that they picked that up just in the last year. They had no debt, and now instead of maybe diluting shareholders, or maybe they couldn't, they took out about $10 million in debt. Not a lot of money. Again, these figures are in thousands. So we have an accumulated deficit here of $217 million. That leaves only about $80 million. I say only, about $80 million in shareholder equity. So these are the things you want to keep in mind if you decide you want to invest in a company like this, because the company has, think about it. Would you go up the street and invest in the restaurant that has $217 million of accumulated deficit after opening? Probably not. So you definitely will want to do your research on this company. So what I'm going to do is put this company on my watch list and kind of keep an eye on it. Maybe do a little bit more research on their financials and their background and the pipeline of products. Find as much information about it as I can, but I'm definitely not going to go run out and buy some shares. Hey, look, if the stock goes up 388%, like Nomura says, well, I don't necessarily have to catch all of that. Even if I only catch the last 100%, that's still a lot of money. So I definitely will be keeping an eye on this stock. Leave me a comment below what you find out. Thanks for tuning in. Hit that subscribe button. Hit that like button. You know you like this. And we'll see you again.